All right, good afternoon. Thank you for joining our webinar today on Strategize, Save, and Simplify 5 Year-End Tax Moves for a Stronger 2026. My name is Brenna Johnson. I'm a certified financial planner here at TrustPoint, and I lead our financial planning department. I've got about over 10 years of experience in the industry, so I'm looking forward to discussing this topic with you, and co-presenting with me today is Heather Jordan.
I'm Heather Jordan. I've been with TrustPoint for about 7 years now. I'm the managing director for Emerj360 and also a certified financial planner.
All right, we'll hop into our topics for today. Just to give you an overview, to remind you that we do have offices in 3 locations. So we're in Minneapolis, Eau Claire, and La Crosse. And TrustPoint has been around, as you know, for over 100 years. And we focus on trust and estate administration, investments and wealth management, retirement plans, foundations and nonprofits, our family office department, and Emerj360. And in case you didn't know, we were voted best places to work 8 years in a row. So for today, our agenda will be to go through some 5 top moves for 2025 into 2026. So we'll talk about some deductions. We will talk about maximizing retirement contributions, Roth conversions, capital gains and loss harvesting, and gifting. So to get started with deductions, we just thought we'd give you a review on the federal tax brackets. You may have heard that the One Big Beautiful Bill Act came through, and it did make our current marginal tax rates permanent with an asterisk, because any administration going forward can always pass new bills that would maybe change that. For as of now, though, they are permanent. And then these rates are indexed for inflation in the coming years. So just as a reminder, these are the brackets that we have to work with. And then in terms of long-term capital gains, essentially it is in the 12% or below, you pay 0 tax. And then when you're bumping up here into the 32%, that's when we're looking at into 20% capital gains. So when we're looking at the difference between standard and itemized deductions, standard deductions means that you just take the flat rate. For anybody that is single, that rate for 2025 is $15,750. If you are married filing jointly, it is $31,500. For those of you that are interested in itemizing, these are the items that can be included in those deductions. So currently, in 2025, you can do medical expenses greater than 7.5% of your adjusted gross income. There is an update with the One Big Beautiful Bill Act, and the SALT or state and local tax deduction did increase to $40,000 this year. We'll talk about that a little bit more coming up. The home mortgage interest on mortgages up to $750,000 can be deducted. And then also there are charitable distributions that can be deducted for itemized deductions. So if all of those add up to more than the standard deduction, we recommend that you itemize your deductions. So as a review, the state and local tax increased to $40,000 for 2025. We have a new senior deduction. We have a new deduction for no tax on tips, and there is another deduction for no tax on overtime. Related to charitable giving for 2026, there is a new adjusted gross income floor and a new 35% cap. So we will talk through those next. So in relation to the SALT deduction, there is a $40,000 increase. It was currently $10,000. So that's been increased to $40,000 for 2025. It does have phase outs, and there is an annual adjustment of 1% for tax years 2026 through 2029. As a reminder, this deduction resets to $10,000 in year 2030. So that's something to keep in mind when you're doing future planning. In terms of the additional deductions that were added on with the One Big Beautiful Bill Act, we have the senior deduction, which is $6,000 deduction for each taxpayer over the age of 65. Again, this is subject to a phase out. It is limited to tax years 2025 through 2028. The no tax on tips deduction is up to $25,000 for cash tips, again with phase outs. This is for an individual who works in an industry which customarily receives tips. So it's not a way to get around trying to have some income go to a tip that normally wouldn't go for a person that is in a service industry. This is also limited to tax years 2025 through 2028. The no tax on overtime deduction is for qualified overtime compensation up to $12,500 for single filers and up to $25,000 for joint filers. Again, there are phase outs for this, limited to tax years, again, 2025 through 2028. Something to remember with all of this, there are different phase outs for different deductions. So the phase out numbers are not the same for all of the deductions. So we recommend that you speak with a tax professional to ensure that you are following into those phase outs if that is the deduction that you're looking to get. So in terms of charitable giving, for 2026, there will be a new AGI floor. So what that means is 0.5% of your adjusted gross income will need to be in place before your charitable deductions over and above that will count. So that is something where we're looking at, we may want to preload essentially some charitable giving in 2025 because there is not that floor in 2025. It will be coming through in 2026. Additionally, with that, there is a 35% cap on charitable deductions if you are in the highest tax bracket of 37%. So that is new again in 2026, something to be aware of. So when we're looking at the different ways that we can maybe be saving some money if we're outside of that deduction phase, we are looking at qualified charitable distributions. So qualified charitable distributions, or QCDs, can begin at age 70 and a half. And what you do is you take funds directly from an IRA, it gets sent directly to a charity, and then you don't pay the tax on it and the charity doesn't pay tax on it. So this is a great way to kind of get around that AGI floor. You can donate at up to $108,000 as of 2025 directly to an eligible 501c3 charity. This is a great tax benefit if you are normally charitably inclined. Another way to work through our new tax laws would be to deduction bunch. So this is where we like to talk to clients a lot about, how can we save money in taxes? So with the new laws coming through in 2026, you may want to front load things at the end of 2025. So what that means is maybe your 2026 real estate taxes, now that we have that $40,000 SALT deduction, maybe we want to pay 2026 real estate taxes in 2025 because we can use that number along with the ones that we already paid in 2025 additionally. You can accelerate some gifts in 2025. So if you're planning to do any sort of charitable giving and you normally do maybe $1,000 a year, maybe we do $2,000 this year and we eliminate doing it next year and then we qualify for the standard deduction next year. Another way that you can also deduction bunch is to contribute to donor advised funds. So as a reminder, donor advised funds are not eligible with a QCD. This would be something separate in your itemized deductions. But a donor advised funds allows you to front load some of your dollars and then you can spread out the grants throughout subsequent years. So this is a great tool if you want to have a larger amount of charitable donations given this year, but you're not sure what you want to spend it on. So we have that option of using those grants in future years to be able to capitalize on your charitable inclinations. You also may want to look at gifting appreciated stock. This is a great way to get full value for your contributions to charities while still not having to pay the capital gains on it. So this is a great way if you've got, at Apple stock that you bought in 1980 that you have huge gains on and you're charitably inclined, you can certainly donate that to a charity and they're able to take that donation at full value and then you do not have to pay the capital gains on that. As a caveat, in 2026, there will be an above the line deduction available of $1,000 for non-itemizers. So you may remember that from back in the COVID years where we had a $600 one. They have increased that to $1,000. So they didn't want charities that maybe only get, 50 to 100, maybe $500 donations from people. They didn't want them to lose out on that 0.5% AGI floor. So there is that option of having at least some of your donations being included in above the line deductions. Again, this is something that is applicable to some people, but not to everybody. So we recommend consulting with your qualified tax professional, and they'll be able to model your specific situation to determine if deduction bunching is good for you. So some of the things to consider when you're trying to figure out if you want to itemize or not, is this a higher than normal taxable income year for you? If it is, then we are going to want to accelerate those itemized deductions. We want to defer any kind of income items such as bonus payouts, sale of a business, or stock options. We want to manage our realized capital gains. It was a great year in the market, but there are some opportunities to be able to harvest some of those losses. So let's look into that as well. And then we want to maximize contributions to retirement accounts, which we'll be talking about next. If you have a lower than normal taxable income year, you want to defer itemized deductions. So you want to take that standard deduction this year. You want to accelerate any kind of income items that would boost that income level. So again, bonus payouts, sale of a business, stock options. You want to realize any capital gains that you can so that we are minimizing the amount of capital gains tax that you would have to pay on that. And another option would be to consider a Roth conversion. This is a great way to convert funds from traditional to Roth and then have those dollars growing tax-free moving forward. Next, we'll refer to our retirement contributions and some tips that we have for that. So with the Secure 2.0 Act, the updates for 2025, currently now, employers are required to automatically enroll employees in new 401k and 403b plans. So you're enrolled at an initial contribution rate of 3%, and that does increase 1% annually until it reaches at least 10%, but not more than 15%. So the purpose of this auto enrollment is to increase retirement plan participation rates because it is an automatic entrance into it. The other thing that we want people to remember is that there are catch-up contributions or super catch-up contributions for workers aged 60 to 63. So for 2025, workers between those ages will be eligible to make larger catch-up contributions to retirement accounts, such as your 401ks, your 403bs, and your 457s. That increased catch-up amount is $11,250 for those that are aged 60 to 63. So normally, if you're over age 50, you can do a catch-up contribution of $7,500, but this gives you that additional amount up to $11,250. Another option that is available now are Roth matching contributions. So employers are able to make their matching contributions to employees in their 401ks into Roth. Previously, the only option was pre-tax. So this does offer some more flexibility for you if you're looking to have some more contributions grow in a tax-free environment. And then looking ahead to 2026, individuals age 50 and over who earn at least $145,000 in the prior year will need to make those catch-up contributions on a Roth basis using after-tax money. So that's something to keep in mind. If you do want to have any catch-up contributions, those will need to be done via a Roth basis. This was originally slated for 2024, but because of the problems with the IRS, it didn't actually come to fruition until 2026. So when we're looking at our contribution limits, we have both 2025 and 2026 here. So you can see for normal employer plans, there was an increase of about $1,000 from 2025 to 2026. The catch-up contribution for 50 and older did increase by $500 as well. The super catch-up did not change. It will not change from 2025 to 2026. Contribution limits for simple plans went up $500 as well. as the 50 and over catch-up. Again, the super catch-up did not increase at all, so that's staying at that 5250. Contribution limits for IRAs, so that's both pre-tax and Roth, are increasing from 7,000 to 7,500 in 2026. And there is a slight catch-up in the age 50 and older of $100. So instead of 1,000, it's 1,100. One thing we want to also draw your attention to there are limits for IRA contributions. So we're looking here at the phase outs for 2025. So for a single or head of household, you're in that right around that $80,000 to $90,000 range. That does increase a couple of $1,000s for 2026. And if you're married filing jointly, we're looking at that 126 to 146,000 range. Again, a slight increase for 2026 indexed for inflation. Roth IRAs for single, we have a phase out from 150 to 165, which increases to 153 to 168. And then married filing jointly, we have 236 to 246, or increasing to 242 to 252 in 2026. There is no increase in married filing separately for those IRA contributions. Another thing we want you to be aware of is if you do any sort of Roth conversions, there is a 5-year rule for Roth IRAs. So every time you do a conversion, it starts the clock ticking for that balance for 5 years. So each year you do it, it starts a new 5-year clock. So we want to make sure that if you need to access any of those funds, any contributions can be taken out within the 5 years. However, any earnings cannot be taken out tax-free until they have been in there for 5 years. So that's something that we want you to be aware of, and make sure that any Roth contributions or conversions are something that you don't need to touch for 5 years. So related to that, we will hop over to Heather, and she will continue our Roth conversion conversation.
Thanks, Brenna. So Brenna touched on this a little bit, but a Roth conversion is an option for people who have traditional IRA balances. Essentially what this is you're taking those pre-tax balances and converting them, moving them into that Roth bucket. You're paying income tax on the amount that you convert. However, it gets those funds into that Roth bucket, gets that 5-year clock ticking, and then funds in that account grow tax-free. This is a really good opportunity if you've retired and you're not yet taking your RMDs. You have this window of time where your tax bracket may be lower than it was before. Really good opportunity to chat with your CPA, chat with your financial planner to see how much can I convert each year to stay in the lowest possible tax bracket. A lot of strategy and planning can be done around this, again, to move funds from that traditional bucket over to the Roth bucket. You pay the tax, however, then they grow tax-free. As you do this, obviously you will pay tax, so just something to be aware of as well, but it's a really good strategy. Again, once you have retired, maybe you're in a lower tax bracket now, moving some of those funds to that Roth bucket. So here shows kind of the pros and cons of that Roth conversion. I'll kind of go over each of these super high level, but the first is income tax. Obviously, if you don't do the Roth conversion, you're not having a taxable event. If you convert funds from that traditional IRA over to the Roth bucket, you do owe ordinary income tax on the amount that you convert. So if you convert $50,000 from your traditional IRA to your Roth IRA, that's like getting $50,000 of income. You have to pay income tax on that full amount. Required minimum distributions. Brenna touched on this a little bit. I'll cover a little bit more in a couple slides as well. But RMDs, or required minimum distributions, are required to be taken from traditional IRA accounts. Once you turn a certain age, right now it's 73, the government says you have to take an RMD, you have to take this certain amount as a distribution and pay the income tax on that. If you start doing some Roth conversions and moving funds from your traditional IRA to your Roth IRA, you're reducing your future RMD because you're moving funds out of that bucket. Roth IRAs do not have a required minimum distribution because you've already paid tax on these. So it just kind of helps with your overall tax situation. The biggest difference, again, between the traditional IRA and the Roth IRA is income tax. Anything that comes out of the Roth IRA is not taxed. because you've already paid tax on it. And then distributions from that traditional IRA are subject to ordinary income rates, not capital gain rates, ordinary income rates. And then again, something else to consider is your beneficiary. So do you want to leave money to beneficiaries tax-free? Does it not matter to you? Any traditional IRA balance that is left to beneficiaries, those individuals will have inherited IRAs and they will have to take RMDs from those accounts and pay income tax. If you have a Roth IRA, you pass away and you have beneficiaries listed, they will also open up an inherited IRA. However, that will not be subject to income tax because you have already paid that when you made the contribution to the account. So there's no right or wrong answer, but the goal is to reduce the total amount of income tax paid, and working with your CPA and your financial planner can help determine how much of a conversion can you do each year to stay in the lowest possible tax brackets. Some 401k plans do allow for conversions within the plan, so be sure to look at that if you have questions on your plan as well. So Roth conversions are really good, again, when you're in lower tax bracket, lower income years. If you are still working and you're of a higher income bracket and you still want to contribute to a Roth IRA, there is something called a backdoor Roth contribution. So this is where if your income is over that threshold that Brenna covered for being able to contribute directly to a Roth IRA, you're able to do the backdoor process, which is making a non-deductible contribution to a traditional IRA and then immediately moving it over to that Roth IRA. This is only an option tax-free if you don't have any other traditional IRA balances out there. So oftentimes, if you have traditional IRAs, you want to do the backdoor process. People who are still working might roll traditional IRAs into their 401k so that they're able to do the backdoor process for a Roth IRA. We have an example on the screen here for John. So he's single, has a pretty high modified adjusted gross income of 450. So he cannot directly contribute to that Roth IRA because he's over that income limit. He has a 401k plan, but no traditional IRA. He is able to make that $7,500 non-deductible contribution to that traditional IRA and then leave that in cash, convert it to the Roth IRA. So that's the backdoor process. You're able to get funds indirectly into that Roth IRA. Again, this works best and is most effective when you don't have any other traditional IRA balances. If you have questions about this and you're working with someone at TrustPoint, please let us know. We work with a ton of clients on this process and figuring out which bucket makes the most sense for them to contribute to. So here we have a really handy chart which shows a lot of the differences between IRAs, 401ks, both on the traditional or pre-tax side and the Roth side. So again, with traditional funds, you're not paying the tax for the contribution, you take it on the distribution. For the Roth bucket, you pay the tax on the contribution, not for the distribution. So kind of opposites in terms of timing. Again, the goal is to contribute to the bucket that is going to allow you to pay the least amount of tax. Those RMDs are, again, just for that traditional bucket. And then the timing, it is a little bit different for 401k and IRA based on which bucket you're choosing to contribute to. For your 401ks, any contributions have to be contributed by December 31st, right? Because those are payroll deductions that go into the plan. You're not able to just write out a check to your 401k. It has to be deducted from a paycheck. For IRAs, you actually have until tax day the following year to contribute. So maybe you get a bonus in January or February of next year. You have until you file your taxes in 2026 to contribute for tax year 2025. So you have a little bit of wiggle room. Some clients do monthly contributions to IRAs if they want to max them out. Some do a lump sum check at the end of the year. Some wait to see if they're going to get a bonus maybe early next year or end of year. So there are different strategies, but just know IRAs give you a little bit more leeway in terms of timing of when you can contribute. All right, so capital gains and loss harvesting. These are two really, really good strategies to think of year end and as things are coming up. The first one I want to talk about is harvesting gains and losses. So when you invest, funds can go up, they can go down. There's a strategy, gain loss harvesting, where Realized losses can offset realized gains. And if you have excess, you're able to use up to $3,000 of that to offset current year ordinary income. So if you have specific funds that are at a loss, you may consider selling those if you don't want to keep them or don't have kind of an emotional attachment to them to offset other gains that are in your account. A lot of funds, have developed a lot of gains over the years, but we still do recommend checking into accounts to see if any funds are at a loss, if it makes sense to sell those, kind of get that loss to have it offset any other funds that we've sold that have had a gain in place. TrustPoint does look at this for all of our client accounts. And if you have specific questions, again, feel free to reach out to your relationship manager and they can take a look at your specific portfolio to see what options there are. But really, really great tool headed into year end to see different options there. And then the next one is analyzing year-end capital gain distributions. So mutual funds do kick off capital gain distributions. They can be short-term, they can be long-term, and they typically happen in December. There are different strategies for the timing of things. If you hold a fund on a certain date, you will be getting that capital gain distribution. So different investment strategies can come into play to say, should we sell this before that date comes up where I would be getting that distribution? Does it make sense to hold it through that distribution date? Be aware of timing of buying new funds. If you buy a fund right before that capital gain distribution, you're still going to get that distribution if you hold it on that certain date. So your investment advisor or financial planner can help you determine what this looks like, but just be aware those capital gain distributions are kicked off at year end and can affect your tax situation. So just be sure to keep your CPA up to date. Perfect. And last section for today for year-end planning, I just want to talk a little bit about gifting. So you may have heard that with the One Big Beautiful Bill, the lifetime gift tax and estate exclusion was permanently increased to $15 million starting next year. This number was set to sunset at the end of this year, but it's now, again, permanently increased until it's changed to $15 million per person. After 2026, this number is indexed for inflation, so it'll go up at whatever inflation rate. And then the annual exclusion amount is $19,000 for 2025, and then unlimited to a spouse. So on the next slide, we have a good chart that shows how you can gift to different individuals. Essentially, you have $19,000 that you can gift to per person per year. So if I wanted to give Brenna $19,000, I could do that. It would not affect my overall exclusion amount. If I gifted Brenna $20,000, that would start to cut into that $15 million. So here you can see if you have two parents, multiple children, grandchildren, you can do some really nice gifting to get funds out of your estate, pay for different things, and those amounts can add up pretty quickly. One thing to know is that direct gifts for education or for medical costs are not considered gifts if they go directly from you to the educational institution or you to the medical facility. If it doesn't go direct to them, then it is considered a gift. So be super careful if you're paying for those things that it's a direct payment, so it's not a gift. And then if you do have a sizable estate and you want to start reducing that, annual gifting is a really good option to do that. Again, it's $19,000 per person. Each parent, if they're married, could give to each child a total of $38,000. Grandchildren, great-grandchildren, you can gift to anyone, again, up to that $19,000. If you go over that, you would have to file potentially that gift tax return. So here's just a summary of the different tax things we talked about. Again, take a look at gifting strategies if that makes sense for you year end. Tax loss harvesting is really, really big this time of year. And just be aware there's been a lot of tax changes. You certainly don't have to be an expert on them, but just kind of know in general what's updated and chat with your CPA to see what other opportunities are there for me to potentially save some tax or do things differently, because it could make a big difference over time. All right, just a couple more slides. So we do have our new magazine out. It's our 7th edition of the TrustPoint magazine. The QR code is on the screen if you'd like to get a copy, but it's a ton of articles written by different TrustPoint staff on estate planning, education planning, retirement planning, all different topics that we see and hear about every day. So super great copy of our magazine, and feel free to scan that if you'd like to receive one. And then lastly, if you'd like to get more monthly news and insights, we do have a monthly newsletter called Viewpoint. QR code is on your screen as well, but again, different articles, videos, if we see things in the market or different things in the economy to update clients or anyone on, that will all be in there. So really great resource to have everything in one spot related to finances. Perfect. Thank you all for attending today. We are recording this webinar if you have extra questions, but please feel free to reach out to TrustPoint or Emerj360 if anything else comes up, and have a great rest of your year.
Thank you, everyone.